Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 102, titled Analyzing Market Assessment Based on Portfolio Setup. Now, when we go to set up our option selling portfolios, one of the factors we integrate into our decisions is our overall market assessment. Is it a bullish environment, a bearish environment, a sideways or consolidating environment? This is important in making our strike selections and selecting the specific securities we're going to be using in our portfolio for the upcoming contract. In this particular podcast, we're going to do the reverse. We're going to take a look at the portfolio as set up by one of our members and try to figure out what was going through his head when he made these selections in terms of both the securities and the strike selections as well. And we're going to be using a real life example with the 5 stock selections that our member made. So let's have a look first at what would be the portfolio setup considerations when we're selecting the securities and the options that we're going to sell against those securities. Well, number one is our personal risk tolerance. When we sell an option, that option will have a certain implied volatility component to it. That will dictate how much premium we're going to receive and how much risk we're going to be taking when we sell that option. Now, the initial time value return goal range is something that we must determine before entering any of our option selling trades. Once we determine this range, that will fall in line with the implied volatility associated with that particular security and option. Then we also must have a look at the moneyness of the strike. In the money strikes, when we sell covered calls, are much more defensive than out of the money strikes, which are much more aggressive. So if we have a market condition that we construe as being bullish, we're more likely to go with an out of the money strike, perhaps one that has higher implied volatility. And the opposite would hold if we had a more bearish assessment of the market, in which case we may go with an in the money strike and securities with implied volatility that are lower. So therefore we would receive less premium, but would also incur less market risk. So our overall market assessment will be directly related to the moneyness of our strike selections, as will chart technicals. So that if we have an all bullish technical chart, well, then we're more likely to go with out of the money strikes for covered call writing. If we had a mixed technical chart where the trend may not be as good or the momentum might not be as good with mixed signals, then we may opt for a more defensive position and use in the money call strikes. So those are the factors that we consider when we're setting up our portfolios. Now here is a real life example with the 5 stocks that was sent to me by one of our members who asked to remain anonymous. And at the time he selected 300 shares of VIPS, which for those of you watching this podcast will be represented by the purple line in the chart. For those who are not watching this podcast, just listening to it, I will be describing the chart in the next slide. 200 shares of ZTO, which is the pink line in the chart. 100 shares of CIEN, Sienna, which is the brown line on the chart. 100 shares of EBS, which is the yellow line on the chart. And finally, 100 shares of RP, which is the green line on the chart. And of course, we're going to look at a comparison chart now, or I'll be describing to you at least, of those 5 securities versus the S&P 500. Now, for those of you watching this podcast, you will see that all of the trend lines on the chart in a 3-month time frame are outperforming the S&P 500. So you could say that the trend is bullish regarding these 5 securities. Now, that doesn't tell us, though, what this investor's overall market assessment is. Because if the overall market assessment was also bullish, then we would expect this investor to lean to out of the money call strikes. Let's have a look. Now, what I did was I put into the Elman Calcula multiple tab spreadsheet the 5 securities with the strike prices that were selected by this investor. And for those of you watching this podcast, you will see that of those 5 securities, 4 of them were in the money strikes that were selected. For example, VIPS was trading at 18, and the 17 in the money strike was selected, which had a option premium of $1.77. So that was an intrinsic value of $1 because the strike was $1 in the money, or lower than the 18 current market value, leaving 77 cents as time value. Now, all 4 of the ones that were selected for in the money strikes, plus 1 was selected RP for an out of the money strike. So 80% of the strikes were in the money. What does that tell us? Well, obviously, this investor had market concerns because he selected 80% in the money or defensive posture regarding the strike selection. So all 5 of the securities, from a technical perspective, were outperforming the S&P 500 over the last 3 months. That's good. But because of the overall market assessment being of concern, this investor went with a predominance of in-the-money strikes to give the additional downside protection. Now, what this averaged out to was the following. The initial time value return on all 5 securities, the 4 in the money and the 1 out of the money, averaged out to 3.14%. Now, for those of you who are like me and like to have an initial 1-month time value return goal range for near the money strikes of 2 to 4%, this would be perfect. 3.14% initial time value return for all 5 of these securities. And for the in the money strike, that would be deducting the intrinsic value. So actual time value initial returns. Now, the downside protection for the 4 in the money strikes averaged out to 5.35%. What that means is on 80% of the portfolio, those securities can go down on average 5.35%, and we still will have achieved our 3.14% average 1-month time value return. It's pretty darn good for a month because that annualizes out to close to 40%. Now, in the 1 strike, where an in-the-money strike was selected, RP was trading at 63.60, and the out-of-the-money 65 call was selected. So there were 4 in the money. This is the 1 out-of-the-money strike, 65 being higher than the 63.60 current market value. That returned a time value return of 3.3%, 1 month, near the money strike, with the opportunity for an additional 2.2% should RP move from current market value of 63.60 up to or beyond the $65 strike price. So there was an opportunity for a 5.5% 1-month return if the price of the stock moved up to or beyond the strike price. So let's summarize now. Since 7 of the 8 contracts or 4 of the 5 stocks were written within the money strikes, this portfolio represented a defensive inclination for those May contracts. Now, the initial time value return average of 3.14% reflects a conservative investor with modest risk tolerance. That's how I would define myself as it relates to my option selling portfolios. I know many of you are going to be more aggressive than me, and many of you are going to be more conservative than me. There are no right and wrong here. But what I'm saying is somewhere between 2 to 4% would represent a conservative outlook and approach to option selling, but yet one with modest risk tolerance. So that's where I stand. Where do you stand? Only you can tell, and there's no right or wrong here. And once we enter our trades, and of course you'll hear me harp on this time and time again, we must enter our buy to close limit orders. If we're selling a 1-month contract, we use the 20% guideline. If we're selling weekly contracts, we would start off with the 10% guideline. But we must implement these the second we enter our covered call trades and have buy to close limit orders, good till cancel. And if they're not executed by mid-contract, we change those 20% thresholds to 10% thresholds. And that will give us protection if share price declines to the point where it's dragging down the option premium value, and we can then close that initial short call and still retain 80% to 90% of the initial time value premium that we generated. Before I go, as always, I'm going to mention a package that we're very proud of, the BCI package, our best and most comprehensive educational product. It consists of so much. Let me just briefly review it for you. There are 6 online video courses related to option selling, both calls and puts. 6 BCI calculators found nowhere else. We developed these calculators. That's why they're only found on the BCI site. 5 of our best-selling books, and we do hold the #1 spot on Amazon for both covered call writing and selling cash secured puts. And these are in ebook format. Plus our annual premium membership, which is 13 months of membership, which includes our reports and the educational components. Just click on the BCI package link on our website to get more details about this package. And most importantly, I just want to go back one slide here. This is the link for the package. And I'm just going to go back one more slide just to remind you of all of the details of that package, which, by the way, includes continuous and never-ending online training in the form of Ask Alan videos and Blue Hour webinars. We have at least one training video added to the member site every single month. And you can go back and review them or go back and review specific topics regarding these training videos. Once again, look for the BCI package link on our website, www.thebluecollarinvestor.com. Ladies and gentlemen, I want to thank you very much for taking the time to listen to and or watch this BCI podcast number 102, Analyzing Market Assessment Based on Portfolio Setup. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.